It's January 12th, and this is, of course, the video log that takes 30,000 to a million. After taking through the account and show you all my positions, I will be discussing a really cool way to get a return, premium, interest, income through selling options and then not missing out on the upside of the underlying asset or the stock that you're selling options against as well. It's going to be very tricky, very unique, and cool way that I thought of doing that. So I want to share that with you, but first let's go through the account. I'm sitting at $145,080 right now after a pretty significant $2,500 drop. Here are my all my positions on the right, starting with the options. This is the ticker, the strike price of the option, whether it's a call or a buy or a put, the expiration date, the number of contracts, and whether it's a sell or a buy. On the right, the number means the change in liability for the day. So you can pause your video at any moment and take a look through the options to try to figure out what my exact positions are. Here are the equities. You'll see that I was pretty heavily hit on my two biggest positions, which are Apple and Realty Income, not including my emerging market bonds. So I'm scrolling through the equities now. You'll see the name of the stock of the company, then the number of shares on the bottom, and then the daily change in value to the right. So these are my positions. That's it. You'll notice there are quite a few changes, and I've sold a ton of EPD puts, and I'm trying to get into that company at $19, or I actually sold one contract at $20 now. But it seems to keep going up, and I don't know if I'll be getting into the company. I could be, but it's looking less and less likely with these kinds of gains. Even on a down day like today, EPD is up almost 2%. It's pretty crazy. Okay, so how do I sell an option? How do I write a contract? How do I sell a put and still maintain a little bit of the upside of the stock that I'm selling my put against? Well, here's how you do it, right? I'm going to show you a live example of Apple, what you could be doing on Apple if you have like $11,000 handy. But if you don't have $11,000 handy, you could just pick a cheaper stock to try this on and see if you like it, see if you like how it goes. You need to be selling options pretty far out in the date duration. Okay, so let's go to Apple here, and then click on the trade options. The first thing when you're trading options is to look at the expiring date. So on the phone and on the browser, it looks very similar. So you click on the or you tap on the date and you pick a date. You want something that's really far out. Okay, so maybe not that far out. How about January 21st, 2022, which is about a year away. So now what you want to do is you want to figure out a price that you want to sell a put to. So you go to sell and then put, two tabs on the top. It's very similar on the phone as well. And then what you want to do is scroll through the price points that you want. Now, the further down the price point, the more safety margin for safety you're going to have. Okay, so you don't want to sell something that's too close to the strike price, because then there's a high chance that the option will have to exercise and you have to purchase, let's say 100 shares of Apple at $128.75 as per this example here. So you want to actually kind of try to avoid that scenario, all right, to give yourself more margin for safety. You want to make this as safe of an investment as you can. And so what you're going to do is you're going to scroll down and pick something that's maybe 120. How about something even safer? How about something like 115 or maybe even lower? What if Apple drops all the way down 110? And I think that's a really good number here. let's stop with 110. Something very unlikely, right? Apple going down back to 110 is, there needs to be some kind of major event happening, like a pandemic or something crazy like a war. I don't know what would drop Apple to 110 now after all their announcements and their earning potential. But anyway, let's say that's a scenario that's plausible but not necessarily going to happen. Not very high chance. So you want to actually sell this put now, okay? So you sell this put and you're going to receive a credit of, let's pick one here. I'm not going to do it live. I'm just going to do a review order. And you're going to get a credit of $1,075. And you're going to need to put up a collateral of $11,000. So what are you getting for that? Now, this is really good return on $11,000. If you put it on a savings account, you probably get $1 in a year. If you put it in a high yield savings account, right now they pay off like 0.35%. You're gonna get like $35. So that's not good either, right? $35 is nothing. If you put it on some kind of bond or anything like that, you get at 1%, which is what the 10-year is at right now. You'll get $100. So that's not a lot for $11,000. Or how about $110? Excuse me, my bad. So how about something that's 10 times higher than that? Sitting at around 10% return is writing a contract, selling a put option on Apple with $110 strike price a year out. Okay, so you sell that and then you take this premium, it's called premium, right? You take this $1,075, and since you don't want to miss out on any upside that Apple has to offer, you go ahead and buy Apple stock. Okay, you just go and buy stock. All right, you find Apple and you just buy some stocks. Okay, so you can put it in amount or quantity, it's up to you. You can choose to buy in shares or dollars. If you want, you can just buy in dollars and type in that amount. Type in $1,075, and you just buy the equivalent in shares, which is going to be a little bit less than 10 shares, right? Like 8 or 9 shares. And so this way, if Tesla happens to go ballistic, right, and go to $200 or something like that, you will have participated in that upside, right? You will have now, let's say, doubles. Okay, let's say doubles in value. So not only are you getting that 10% from, basically getting these stocks for free, okay, through the premium, just by locking that $11,000 out into a lockbox, and you can't play with it, you can't access it for a year. You're getting these shares for free. And so now imagine a scenario that the price of Apple doubles in a year. That basically means that you get double your interest. So now you're getting a 20% return on your initial investment of $11,000. So that's fantastic. Who wouldn't want a 20% return? That's great. Now, what if something bad happens? Okay, what if, for example, the price doesn't change? Well, you still get those 10 shares for free. Okay, a year from now, you get your $11,000 back, and those 10 shares are still in your account at the same price they were before. So you still have those 10 shares, or less than 10 shares. What if something even worse happens? What if the price goes down? Well, let's say the price goes down to the, unthinkable happens, and price goes down to $110 a year from now. Well, you're going to be forced to buy. You're going to be forced to buy with that $11,000, 100 shares of Apple. So now you're going to have a total of 109 shares or so. And your average cost price is going to be, a bit over 110, but not by much, because you're buying the majority of the shares at the 110 level, So your cost basis is gonna be like 112 or something, 115 at the most. This is approximate math, okay? Which is a lot better price than buying Apple right now. Okay? So you see how this works to your benefit? I mean, yeah, if Apple drops down 110, um, you're gonna, your purchase price is gonna, let's say even 105, your purchase price is gonna be higher than that. However, it's still gonna be, you're gonna be in a lot better position than you would be if you were to buy Apple shares, $11,000 worth of them right now. So what you're basically doing here is you're trading the upside of $11,000 worth of Apple shares, and in return you get a you get 10% free. I'm sorry, not 10%. You get nearly 10 shares free Apple stock, and that's basically what you're getting. and the opportunity, okay, the opportunity to own more Apple shares at a lower price, okay, at $110 strike price. So that's what you're getting on the other side of the trade, okay? So a better entry point and some free shares. And you're trading that for the possibility that Apple skyrockets and gives you some crazy YOLO returns. So I think it's a fairly good trade. I've done something similar to that in the past, and it's worked out pretty well. Now I probably would have done better if I invested the money in Apple straight up, but if I'm not convinced that it's going to travel that high that fast, then I might want to do something like this. So I haven't done it this year. I did it last year, and it paid off. But it's just one option. If you look at it the way I look at it, then it makes a lot more sense than just selling puts and doing whatever, right? And I know $11,000 is a lot. So what you wanna, if you have a smaller account, what you want to do is find a stock that you know it's not going to go below a certain point, and try the same operation there at a much lesser, collateral requirement. So something, if you get a $10 stock, your collateral would be $1,000. So you could do it at 10,000, maybe Ford or something like that. I don't. None of this is investment advice, of course. I'm just throwing names out there that fit this similar price point. I don't know what Ford is going to do, etc. Before investing any money in the market, you want to make sure that you do your own research and own due diligence, and make sure that you know that you can lose 100% of your principal, all of your money. You can use everything in the markets if you don't do things right. It's possible. So anyway, you can find a lower price stock, and then you only need $1,000 or something to put up, and hopefully you can get that 10% return in a year, and you can get 110. I'm sorry, $1,100, $1,100, or $1,200 in a year, depending on how the stock goes. And I know these sound like modest returns, but believe me, they are not modest. If you're looking for super high returns, if you have $1,000 account and you're thinking, oh well, I need to at least double it in a year, that's pretty greedy. Okay, it's really greedy, but it's not impossible. But you know what else is not impossible is playing roulette, right? And getting a big payoff on roulette. What's also not impossible is playing blackjack for a night and tripling or quadrupling your money. What also not impossible is winning the lottery. Okay, so we have to understand, and what I need to understand, what everybody needs to understand, is that very often, huge rewards come with a lot of risk. So it's going to be very, very difficult for anyone to get a high return on their money without substantial amount of risk on the downside. So if you want to, keep buying Tesla YOLO calls, you can do that, and you can make some money. You can triple, quadruple, quintuple, whatever your money in a week or two. But you could also lose it all very, very, very easily. So And this is just a safer way to get some pretty crazy returns relative to the investment world expects, right? I mean, nowadays S&P is kind of like the benchmark, so if you get less than the S&P 500, it's considered not good, but traditionally a 10% return is very, very good. I mean, a lot of people lock it out, and it's very safe, right? So that's what I'm saying. It's a pretty safe way to get 10% return. Many people buy treasuries, which is government bonds, and they only return 1% per year. So how would you like to take your $1,000 and at the end of the year get $10 back from your amazing investment? This doesn't sound very good, right? All of a sudden, 100 or 200 bucks sounds pretty lucrative. All right, guys, I've shared this strategy with you. Let me know if you like it or if you've tried it in the past. I sure have. On this channel, actually, if you look back a year or something like that, a year or two, from the beginning, you'll see I did this with Apple back in the day. So, anyways, hopefully you'll find this useful, at the very least, slightly entertaining. And let me know if you're winning or losing on these markets. I'm certainly losing today, so we'll see how tomorrow pans out. All right, with that said, peace out.